In 1907, a banking panic nearly collapsed the American financial system.
Depositors rushed to banks, desperate to withdraw their savings.
Without a central bank, the system struggled to stop the panic.
6 years later, Congress created the Federal Reserve.
For the first time, the United States had a central bank.
The Federal Reserve began operating in 1914. It was designed as a system of regional central banks. A central board in Washington would guide national policy.
The goal was to bring stability to the banking system.
But controlling money would prove far more complicated. The Federal Reserve began operating in 1914.
It was designed as a system of regional central banks.
Wilson has Clancher note. A central board in Washington would guide national policy.
The goal was to bring stability to the banking system.
But controlling money would prove far more complicated.
After World War II, the American economy entered a long expansion.
The Federal Reserve began shaping modern monetary policy. But by the 1970s, inflation began spiraling out of control. In 1979, the Fed took drastic action to fight inflation. Interest rates surged to levels never seen before. By the late 20th century, the Federal Reserve had become central to financial markets. Low inflation and steady growth defined much of the 1990s. But in the year 2000, the technology bubble burst.
The Federal Reserve responded by rapidly lowering interest rates.
Cheap credit soon fueled a massive expansion in housing.
Low interest rates helped ignite a powerful housing boom.
Mortgage lending expanded rapidly across the country.
Home prices climbed to record levels.
But by 2007, the housing market began to weaken.
The crisis soon spread through the entire financial system.
By 2008, the crisis had reached the heart of Wall Street.
In September 2008, Lehman Brothers collapsed.
Global financial markets plunged into panic.
The Federal Reserve launched massive emergency interventions. The Fed began injecting liquidity into the financial system.
Through quantitative easing, the Fed began purchasing massive amounts of bonds. Gradually, financial markets began to stabilize.
Because the dollar remains the backbone of global finance.
This expansive global transit hub symbolizes our interconnected economies. The U.S.
Most international trade is priced and settled in dollars.
Banks around the world depend on access to dollar liquidity.
When the Federal Reserve changes policy, global markets react. A single policy decision in Washington can ripple across the world.
Several times each year, the Federal Reserve meets to decide interest rates.
Spectry questions for Heater Court 5. This group is known as the Federal Open Market Committee.
When the Fed announces a decision, markets react immediately.
Stocks, bonds, and currencies move within seconds.
The influence of the Federal Reserve extends far beyond the United States.
Interest rate changes in the United States affect the entire global economy. Global investors constantly track signals from the Federal Reserve. When interest rates fall, borrowing becomes cheaper for households.
Businesses also expand when financing becomes more affordable.
But when inflation rises, the Federal Reserve tightens policy.
The Federal Reserve plays a central role in economic cycles.
When monetary policy is loose, credit expands across the economy. When policy tightens, borrowing slows and growth cools.
These policy changes ripple through global financial markets. Central banks have become the architects of modern finance.
In the modern financial system, central banks operate at the core of global finance.
The US dollar sits at the center of international capital flows.
Investors across the world analyze every signal from the Federal Reserve.
A policy decision in Washington can shift markets across continents. In many ways, the Federal Reserve helps shape the direction of the global economy. The Federal Reserve does not control the economy directly,
but its policies influence nearly every financial decision.
The ripple effects of central banking spread across continents.
In the modern financial era, central banks shape economic stability.
Few institutions influence money as deeply as central banks.
Investors around the world analyze every signal from the Federal Reserve.
The reason lies in the global dominance of the US dollar.
A policy decision in Washington can move markets across continents. Understanding money today means understanding the power of central banks.